Our stock of the day, we're taking a look at QBE. It is in the news for a couple of reasons this morning. First up, it signed a long-term agreement with Kogan to provide home, motor and CTP products through Kogan Insurance, which will launch later this year. QBE's Managing Director Eleanor DeBell saying the partnership will see the company deliver best practice online service to Kogan's 3 million customers. The other issue, of course, at the moment, particularly affecting Sydney and the broader regions down the east coast, is the weather. And that is certainly a focus for insurers and QBE, with Citi today upgrading QBE to a buy as it expects the company to best manage rising costs brought on by higher weather allowances and reinsurance costs. Although shares have dipped in the morning trade, currently off around 1.5%. So let's see what our experts think. Luke, certainly we do have disasters being a big feature. That's certainly affecting insurers at the moment as far as and where premiums are likely to go. The other point, which I was alluding to there, were interest rates and where they're heading and how that affects insurers. How's QBE placed at this point?
Yeah, look, I think one of the greatest mysteries to me of investing is how Warren Buffett, the world's greatest investor, has done so well out of insurers, because they're inherently average businesses, and for all those factors you just outlined, but they're inherently commodity products, very competitive. The best insurers go out there and find niches where they can really dominate that niche and extract a moat around it. That's not QBE. QBE is the behemoth, and every 3 or 4 years QBE downgrades because they've been exposed to a South American auto insurance or a Middle Eastern, whatever insurance. It's a behemoth where I think even management don't really know what they're exposed to at times. So a lot of moving parts. I think that overall trend of, be it global warming or whatever, it's clearly, it's increasing, this natural disasters and the scale as well. That's not a positive for them. Rising yields is always the tailwind that people talk about with insurers. They're exposed, their float obviously on the yields. The short term, I agree with that. I think as you've seen bond yields rise, they will get that benefit in the next maybe year or two. But it's capitalism, right? And at some point, these businesses will reprice their insurance book because they're making more profits on their float through the returns. So I think it's a bit of a net longer term. Yes, you'll make more on your float, but because of that, competition will whittle away at the pricing end of the insurance. The Kogan stuff, I think, it's not a bad announcement. Obviously, you're expanding some distribution with a brand name. QBE, like I said, is a behemoth. I think in the grand scheme of things, it probably doesn't bring in that much. For me, look, I've had QBE and the other big insurers as a sell for a while, to be honest. And my opinion probably hasn't changed, even despite that rise in yields we've seen over the last few months. Yeah,
that's interesting. Gaurav, your thoughts there? I mean, insurance, it is such a dynamic sector at the moment.
Well, there's a surefire way of making money from QBE specifically, Andrew, and that is just to do the opposite of what I tell you to do. Because I've got a dreadful track record on this stock. Intelligent Investor has gotten this wrong multiple times, and the conclusion I've come to is that an analyst's time is better spent than on this stock, because the complexity and the variables are so broad that you can never really understand this business. Everyone thinks that insurance is pretty straightforward and that you should invest in straightforward stocks. Well, this is neither understandable nor straightforward. It's actually just a black box. You don't know what they've written. You don't know the risks inherent. The reinsurance is a mystery. I challenge anyone to come up with an adequate way of understanding what these guys are going to make in any given year or even over time. I think Luke's point earlier is absolutely crucial. This has become the lazy man's exposure to interest rates, but what most investors, I think, don't recognize is that insurers make their money two ways. One is from their float and one is from the actual insurance itself, and those things largely cancel each other out. So in times of low interest rates, they're much more competitive on the insurance part, and in times of higher interest rates where they make money on the float, the prices on the insurance book start to fall. So there's no free lunch here. There's no easy way to make money from QBE or insurance generally. I think this is a poor quality business that's very difficult to understand, and for me, it's almost uninvestable. Wouldn't buy it at almost any price.
Wow, that's interesting take from both of you. That is QBE.